If you're entering trades the moment you see movement, you're probably bleeding money. Most traders don't lose because their strategy is bad. They lose because they can't wait. You see a candle move, your heart races, and boom, you're in too early. Here's the twist. The real edge in trading isn't finding more setups. It's learning to sit on your hands while everyone else jumps in. In the next few minutes, you'll learn exactly how to build sniper-level patience, spot ONLAF setups, and stop donating money to the market. Because if you don't fix this, the market will keep teaching you the same expensive lesson. The market does not pay you for being busy. It pays you for being right at the right time. That is a lesson most men learn only after the market has taken its tuition in full. You want to know why most traders fail to wait for proper setups? It is not because they cannot see the chart. It is because they cannot govern themselves. The tape is not your enemy. Your impatience is. I learned early that the big money was never made in the buying or the selling. It was made in the waiting. Yet how many times have you watched a chart start to move and felt that familiar itch in your fingers? You know the feeling, don't you? The market twitches and suddenly you must be in. That is not trading. That is compulsion dressed up as opportunity. A proper setup is like a train pulling into the station on schedule. It has a look about it, a certain rhythm in the price, a behavior in the volume, a structure on the chart that speaks clearly to the practiced eye. But most men never hear it because they are too busy jumping at shadows. The first thing you must understand is this. The market spends most of its time doing nothing worth your money. Let me repeat that because it runs against the instincts of nearly every beginner. Most of the time there is no trade. Have you noticed how the market chops sideways, fakes one way, then the other? That is the market testing your patience. And patience, my friend, is capital. Spend it wisely, or lose your stake. Now, how does a man learn to wait? He begins by accepting that opportunity is selective. The market is not a buffet where you sample every dish. It is more like hunting. You do not fire at every rustle in the bushes, at least not if you intend to stay in the game. When I studied the tape, I was not looking for action. I was looking for confirmation. Price must behave properly. Volume must support the move. Structure must make sense. If one piece was missing, I waited. Could you do that? Could you sit on your hands while the market dances without you? Most cannot. That is why most accounts are smaller, 6 months from now. There is a dangerous illusion in trading, the belief that more trades mean more profit. In my experience, the opposite is usually true. Overtrading is simply impatience made expensive. Every unnecessary position is a commission paid to your own lack of discipline. The professional understands something the amateur does not. Preservation comes first. You do not enter the market to prove you are clever. You enter when the odds are clearly in your favor. Look at your charts carefully. A true setup has characteristics. It forms near key levels. It shows orderly price movement. It does not look frantic or confused. When the market is uncertain, the wise trader is uncertain too. Tell me, when you review your losing trades, how many of them came from boredom? How many came from that quiet voice saying, maybe this one will run? The market has a way of punishing. Maybe waiting is not passive. That is another misunderstanding. Waiting is active observation. It is study. It is preparation. While others are firing bullets wildly, you are measuring distance, wind, and timing. You must train your eye to recognize quality. One practical way is this. Define your setup so clearly that there is no room for negotiation. Write it down if you must. What must price do? Where must it be located? What must volume confirm? If your rules are vague, your waiting will be weak. Have you ever show less 424 noticed how the best trades feel almost obvious in hindsight? That is because proper setups tend to be clean. They are not hidden in chaos. They emerge from structure. The trouble is, most traders grow uncomfortable during quiet periods. They feel they must be doing something. But in speculation, activity is often the enemy of results. Your job is not to trade often. Your job is to trade well. There is also the matter of emotional capital. Every trade you take, win or lose, consumes attention, energy, and focus. When you trade too frequently, your judgment dulls, your standards slip. Soon you are taking trades you would have rejected a week earlier. Have you felt that downward slide before? The cure is simple in principle, though not easy in practice. Raise your standards, become harder to impress. Demand that the market prove itself before you risk a dollar. When price approaches your level, do not rush. Watch how it behaves. Does it hesitate? Does volume expand? Does the move have sponsorship behind it? Or is it thin and nervous? The tape always tells a story, but only to those patient enough to listen. There is another truth most men resist. Sometimes the best position is no position at all. Cash is a position. Waiting is a position. Observation is a position. But the impatient trader feels naked without a trade on. He equates stillness with missed opportunity. That is costly thinking. You must rewire that instinct. Start by reviewing your past trades honestly. Mark the ones that met your full criteria. Then mark the ones you forced. The difference will likely be painful but instructive. From there, build a simple rule. No setup, no trade. Not most, not close enough. No setup, no trade. Will you miss some moves? Certainly. Even the best operators do. But missing a move never broke a trader. Taking poor trades repeatedly, that does the damage. Remember, the market will open again tomorrow, and the day after that. Opportunity is patient, even if traders are not. If you wish to build real wealth in speculation, you must think in terms of selectivity and preservation. The man who survives long enough with capital intact eventually meets the right opportunity. The man who cannot wait is usually gone before it arrives. So the next time you feel that familiar urge, that little push to jump in early, pause. Ask yourself one question. Is this truly my setup, or am I just tired of waiting? A true setup has structure, confirmation, and timing, not hope. That distinction separates the operator from the gambler more cleanly than any indicator ever will. Most men in the market are not really trading a setup. They are trading a feeling. They see movement. They imagine profit, and they act. But the market has a way of humbling imagination when it is not backed by evidence. Structure comes first. Price must be in the right place. It must be near a level that matters. Support, resistance, a well-formed base, or the edge of a clear trend. Without location, there is no context. And without context, there is no edge. You must train yourself to ask, where is price in the larger picture? Is it extended and tired, or is it coiled and prepared? Too many traders focus on the candle in front of them and forget the landscape around it. Have you ever entered a trade that looked good on one small time frame only to realize later you were buying straight into higher time frame resistance? That is what happens when structure is ignored. The chart was speaking, but you were listening only to the part you wanted to hear. Once structure is present, confirmation must follow. Price alone is not enough. Markets often tease fake and reverse. Confirmation is the market proving its intention through behavior. This may come in the form of strong volume, clean momentum, orderly pullbacks, or a decisive break with follow-through. The key is that the market must do something measurable, something objective. Hope, on the other hand, requires no evidence. Hope says it looks like it might go. Confirmation says it is already beginning to go, and the conditions support continuation. Do you see the difference? One is anticipation without proof. The other is observation backed by behavior. Many traders blur this line because they are eager. Eagerness lowers standards. The moment you find yourself saying, well, it's close enough, you are no longer trading your edge. You are negotiating with it. And the market is a poor place to negotiate from weakness. Timing is the third piece, and it is often the most neglected. A market can have perfect structure and clear confirmation, yet still punish the trader who enters at the wrong moment. Good timing means entering when risk is defined and momentum is aligned. It means not chasing price after it has already made its move. It means allowing the setup to fully form before committing capital. Tell me honestly, how many times have you watched a move begin, hesitated for a moment, and then jumped in late out of fear of missing out? That is poor timing driven by emotion. The professional waits for price to come into his zone. He does not run after it like a man chasing a departing train. Good timing often feels uncomfortable because it requires restraint. You may see price approaching your level and feel the urge to anticipate the move. But anticipation without confirmation is simply hope wearing technical clothing. The disciplined trader waits for the market to cross the line first. There is also a rhythm to proper setups that becomes clearer with experience. Clean markets move with a certain orderliness. They build, pause, and then expand. Messy markets whip back and forth, printing confusion on the chart. One invites participation. The other demands caution. Your job is to become sensitive to that difference. This is where many traders sabotage themselves. They know intellectually what a good setup looks like. They have studied charts, marked levels, and memorized patterns. But when real money is on the line, emotion begins to whisper. It says, maybe this time we'll run. It says, you don't want to miss this one. And slowly, the trader begins to relax his rules. The market notices. Every time you take a trade based on hope instead of structure, confirmation, and timing, you weaken your own discipline. You train yourself to accept lower quality opportunities over time. Your average trade quality declines, even if your strategy on paper remains the same. The solution is not more indicators, it is sharper selectivity. Before every trade, you should be able to point clearly to the structure. You should be able to explain the confirmation in plain terms. And you should know exactly why the timing is favorable now. Not 5 candles ago, not 3 candles from now, but now. If any of those pieces are missing, the trade is incomplete. This mindset changes how you see the market. Instead of hunting constantly for something to do, you begin filtering aggressively. Most charts become immediate passes. Most movements lose their power to tempt you. You start to recognize that quality setups are relatively rare, and that is precisely why they are valuable. It also changes your relationship with patience. Waiting no longer feels like inactivity. It feels like preparation. You are not sitting idle. You are screening for alignment, structure, confirmation, timing. Define your setup so clearly there's no room for negotiation. That single habit will save more accounts than any indicator ever invented. Most traders do not lose because they lack intelligence. They lose because their rules are soft, flexible, open to interpretation at the worst possible moment. When money is on the line, the human mind becomes very persuasive. It will bend your rules just enough to justify almost any trade. Have you noticed that the setup is almost there? The level is close enough, volume is good enough, and before you know it, you are in a position that never truly met your standard. That is what happens when your setup is not defined with precision. A proper operator knows exactly what he is waiting for, not vaguely, not in general terms. Specifically, price must reach a certain area, structure must form in a certain way, volume must behave in a certain manner, timing must align within a certain window. When these conditions are written clearly in your plan, the decision becomes mechanical, and mechanical decisions are far less emotional. Think of it this way. The market is always offering you something, always moving, always printing candles, always creating the illusion of opportunity. If your rules are loose, the market will constantly find ways to tempt you. But if your setup is tight and well-defined, most of what you see will automatically be rejected. Have you ever sat in front of the chart and felt uncertain whether a trade qualified or not? That uncomfortable gray area is dangerous territory. It is where discipline quietly erodes. The professional reduces gray areas wherever possible. Start with location. Where must price be for your setup to even exist? If you cannot answer that instantly, your definition is too weak. Somewhere near support is not precise. Within my defined demand zone after a pullback is getting closer. Precision removes debate. Next comes behavior. What must price actually do when it reaches your level? Does it need to show rejection, consolidation, a clean break, and retest? Too many traders mark levels but never define the behavior they require at those levels. The result is predictable. They enter on touch alone and hope the rest works out. Hope is expensive in this business. Then there is confirmation. What evidence tells you the move has real participation behind it? Is volume expanding? Is momentum clean? Are higher time frames aligned? Your setup must answer these questions before the trade is placed, not after. Let me ask you something plainly. When you review your losing trades, how often do you notice that one key piece of your setup was missing and you took the trade anyway? That is negotiation. And the market punishes negotiators. A well-defined setup acts like a filter. Most opportunities fail the test immediately. That is not a problem. That is the entire point. Selectivity protects capital. The trader who waits for full alignment may take fewer trades, but each trade carries more intentionality. There is also a psychological advantage here that many overlook. When your rules are crystal clear, your mind becomes quieter during live trading. You are no longer debating every candle. You are simply checking conditions against a checklist. Either the setup is present or it is not. This reduces emotional fatigue in a very real way. Another important element is documentation. If your setup only lives in your head, it will evolve under pressure. Write it down. Spell it out. Some of the best operators I have known could describe their setup in plain language without hesitation. Can you do that right now? If I asked you to state your exact entry conditions, your exact invalidation point, and your exact confirmation requirements, could you explain them clearly in under 30 seconds? If not, the market is still negotiating with you. Clarity also improves your post-trade analysis. When your rules are precise, reviewing performance becomes honest. You can quickly see whether you followed your plan or violated it. But when your rules are vague, every losing trade can be rationalized. And rationalization is the enemy of progress. There is a discipline muscle involved in all of this. At first, you will still feel the pull to bend your criteria. You will watch moves leave without you. You will feel that familiar fear of missing out. That is normal. The market is very good at testing resolve, but something interesting happens when you hold your ground consistently. Your eye sharpens, your patience strengthens, and slowly the charts begin to look different. You start to notice that many of the moves you once chased were never truly clean. They were rushed, extended, or poorly supported. By raising your standards, you naturally avoid much of the market's noise. This is not about perfection. No setup wins every time. Even the cleanest structures can fail. But a clearly defined setup ensures that when you do lose, and you will, you lose within a controlled, intentional framework rather than from impulse. That difference is what keeps traders solvent long enough show less 1739 to improve. Over time, your relationship with the market becomes more professional. You stop feeling the need to participate in every fluctuation. You become comfortable letting mediocre opportunities pass. You begin to understand that the real game is not finding more trades. It is filtering aggressively until only the best conditions remain. No setup, no trade, no exceptions. That rule sounds simple when spoken calmly, but the market has a way of testing it when money, motion, and emotion all collide on the screen at the same time. Most traders agree with this principle in theory. They nod when they hear it. They even write it in their journals. But when price starts moving quickly, when the candles get large and the chatter gets loud, the rule begins to soften. Have you noticed that in yourself the danger is not in breaking the rule once the real danger is in teaching your mind that the rule is flexible? Because the moment your brain learns that exceptions are allowed, it will start manufacturing reasons to take them. The market thrives on that weakness. A man who trades without a setup is not operating. He is reacting. He is letting the market pull him by the nose instead of waiting for conditions that favor him. And reaction in speculation is usually expensive. You must understand what this rule is really protecting you from. It is not just guarding your capital. It is guarding your decision-making process. Every impulsive trade chips away at your discipline. Every exception makes the next exception easier. Tell me honestly, when you look back at your worst trades, how many of them truly met your full criteria? Not the almost trades, not the close enough trades, the full criteria. Most traders, when they answer truthfully, discover something uncomfortable. Their biggest losses often came from trades they knew were second-rate before they ever clicked the button. That is not a market problem. That is a standards problem. The professional operator builds a wall between himself and low-quality opportunities. That wall is the rule. No setup, no trade. It must be absolute because the market is clever. It will present situations that look tempting, but incomplete. Price will move near your level, but not quite behave correctly. Volume will expand slightly, but not convincingly. Structure will form, but remain messy around the edges. And in those moments, your patience will be tested. You will hear the quiet voice. Maybe this one will work. That voice has emptied more accounts than bad strategies ever have. The disciplined trader does something different. He treats his setup like a checklist that must be fully satisfied. Not partially, not mostly, fully. If one key piece is missing, he stands aside, not because he enjoys waiting, but because he understands the long game. Have you ever watched a move run without you after you followed your rules and stayed out? That can sting. No question about it. But there is an important truth most traders learn too late. Missing a trade is emotionally uncomfortable, but taking poor trades repeatedly is financially destructive. One hurts your feelings. The other drains your account. When you truly adopt the rule of no setup, no trade, something begins to shift inside your process. The charts stop feeling like a constant call to action. The noise loses some of its power over you. You begin to see how much of the market's movement is simply not worth your risk. This is where selectivity starts to compound. Fewer trades, cleaner entries, better emotional control. But make no mistake, this discipline must be trained. At first, your fingers will still feel the urge to act. You will still feel that restless energy when the market is moving and you are flat. That is normal. You are rewiring a habit loop that most traders never fully break. One practical method is brutally simple. Before every trade, force yourself to verbally confirm your setup criteria out loud if necessary. If you cannot clearly state why the trade qualifies, you have your answer. Another powerful exercise is reviewing your trade history with honesty. Separate your trades into two show less 2203 groups, those that fully met your setup and those that did not. Then compare the results. The market is usually very honest in this regard. It often becomes painfully obvious which category is doing the damage. There is also a deeper mindset shift involved. You must stop measuring success by how often you trade. Activity is seductive. It feels productive. It gives the illusion of engagement. But in speculation, restraint is often the higher skill. The best operators are not constantly in the market. They are constantly observing, filtering, and preparing. When their moment comes, they act decisively. Until then, they are perfectly comfortable doing nothing. Could you reach that level of comfort? Because the truth is, most traders never fail from lack of opportunity. They fail from lack of selectivity. They see too much, take too much, and gradually dilute their edge until it disappears into noise. The rule, no setup, no trade, is your safeguard against that slow erosion. Most losses come from entering too early, not from bad strategies. That is a hard truth for many traders to accept, because it is far more comfortable to blame the method than to question one's own timing. Yet, if you study enough trade histories, your own included, a pattern begins to reveal itself. The strategy was not always wrong. The entry was. The market has a rhythm. It expands, pauses, builds pressure, and then moves again. The patient operator learns to recognize when that pressure is properly formed. The impatient trader sees the first twitch and assumes the move has already begun. Have you ever watched a trade move against you immediately after entry, only to later move exactly in the direction you originally expected? That is the signature of early entry. Your idea was not flawed. Your timing was premature, and premature entries carry a hidden cost. When you enter too early, your risk becomes distorted. Your stop must be wider to survive normal market noise. Your emotional stress increases because price often moves against you before it moves for you. And worst of all, your confidence begins to erode because you start associating good ideas with poor results. The amateur often misdiagnoses this. He thinks the setup failed. In reality, he simply showed up too soon. The market rarely rewards anticipation without confirmation. It has a habit of shaking out the eager before rewarding the patient. This is not random behavior. It is the natural byproduct of liquidity and crowd psychology. Early traders provide fuel for the move that comes later. You must decide which side of that equation you intend to stand on. There is a subtle emotional driver behind early entries that many traders never fully confront. It is the fear of missing the move. The chart begins to lean in one direction, and the mind starts racing ahead. If I don't get it now, it will run without me. Sound familiar? That thought has probably cost more money than any indicator failure ever recorded. The disciplined trader reframes the situation. He understands that the market offers endless opportunity over time. Missing one move is not fatal. Entering poor trades repeatedly, that is what compounds damage. One useful exercise is to review your losing trades and mark the exact moment you entered. Then compare that entry to the ideal confirmation point your strategy actually requires. The gap between those two moments is often very revealing. In many cases, you will see that price had not yet broken structure. Volume had not yet expanded. Momentum had not yet aligned. Yet the trade was taken anyway. That is not strategy failure. That is impatience in action. Early entries also tend to create emotional turbulence during the trade itself. Because the position is open before the market has fully committed, price often drifts sideways or pulls back. This tests the trader's nerves. Doubt creeps in, stops get moved, plans get adjusted mid-trade. Have you experienced that uneasy feeling where you are in the trade but never quite comfortable? Properly timed trades tend to feel different, not always easy. Nothing in speculation is easy, but cleaner. Price behaves with more purpose. The trade structure makes sense. Risk is defined more tightly. The position does not feel like it needs constant babysitting. That difference is often timing. The solution is not complicated, but it does require restraint. You must force yourself to wait for evidence. Let the market show its hand first. Let structure break cleanly. Let volume confirm participation. Let momentum prove that the move has real sponsorship behind it. In short, make the market do the work. This runs counter to the instincts of most beginners who feel they must predict the move before it happens. Prediction feels intelligent. Waiting feels passive. But in real market operations, waiting is often the more professional posture. There is also a mathematical advantage to proper timing. When you enter closer to true confirmation, your stop distance often shrinks. Your risk becomes more efficient. Your reward-to-risk profile improves naturally. Over many trades, that efficiency compounds in meaningful ways. Early entries rarely offer that benefit. They often require giving the trade extra room, which quietly reduces your edge over time. You must also accept that waiting for proper timing means you will sometimes watch price move without you. That is part of the business. The trader who cannot emotionally tolerate missed moves will almost always enter too early at some point, and the market senses that urgency. It is patient. It will wait for you to act prematurely. Then it will test your conviction immediately. The professionals understand something the crowd does not. You do not need to catch the exact beginning of a move to profit from it. The middle of a clean move is often far more reliable than the very start. But the ego loves to be early. It feels clever. It feels predictive. Unfortunately, the market does not pay bonuses for clever feelings. It pays for disciplined execution. So the next time you feel that urge building, the chart leaning, the candles growing, your finger hovering, pause and ask yourself one honest question. Raise your standards until average trades no longer tempt you. That sounds simple when spoken calmly, but in the heat of the market, it becomes one of the hardest disciplines a trader can build. The chart is always moving. Candles are always forming. There is always something that almost looks good, and almost is where most accounts slowly bleed. The average trader operates with standards that are far too forgiving. If the level is close, if the pattern is decent, if the volume is somewhat supportive, they convince themselves it is good enough. But the market has a sharp memory for mediocrity. It does not need to punish you dramatically. It only needs to be slightly unfavorable consistently, and over time, the damage compounds. Have you noticed how many of your frustrating trades fall into that middle category? Not terrible, but not truly clean either. That is the danger zone. When your standards are low, the market always looks tradable. Every small move feels like an opportunity. Your screen stays busy, your account stays active, and your emotional energy stays constantly engaged. But activity is not the same thing as progress. The professional learns to become difficult to impress. He looks at most charts and sees nothing worth his capital. Not because opportunities do not exist, but because his filter is sharp. Structure must be clean. Location must be precise. Confirmation must be convincing. Timing must be aligned. If any piece feels forced or messy, he steps aside without hesitation. Could you do that consistently? Raising your standards changes the entire texture of your trading. At first, it can feel uncomfortable. Trades you once would have taken now get rejected. You may go longer periods without entering the market. There will be moments when price moves without you, and your instincts will protest. That is the adjustment phase. Your mind has been conditioned to equate action with productivity. But in speculation, selectivity is often the real edge. The fewer trades you take, the more each one must justify its existence. One useful exercise is to review your last 50 trades and grade them honestly.